Environmental social governance, or ESG for short, is a broad topic, and how investors approach it will differ based on their own views and beliefs. Whilst this is not financial advice, in this video I will outline a broad framework which investors can follow should they wish to integrate ESG considerations into their investment strategy. I'm Joe Condy, an investment consultant at Quantum Advisory. As a starting point, investors should receive training and education on ESG matters, covering areas such as regulations and guidance, particularly for pension schemes and charities, for example, the benefits and drawbacks of integrating ESG, the types of investment strategies that managers employ, climate change considerations, and much more. Appropriate time should be provided to allow investors to discuss ESG, and importantly, the ESG factors which they believe is important to them and the beneficiaries of the assets that they are responsible for. After receiving training and discussing in detail what is important to investors, they should aim to define and agree their investment beliefs, which include the potential risks and opportunities relating to ESG. In the past, we have drafted targeted questionnaires for clients, which aim to draw up their investment beliefs, and the results were then discussed with the clients where any conflicts or inconsistencies were ironed out. Once these have been agreed, the beliefs should be documented in a statement of investment principles or investment policy document. As part of this step, communicating the beliefs to various parties like sponsors, members and beneficiaries is a good idea from a transparency perspective. For the majority of our clients who invest in pooled funds managed by asset managers, the third step in the framework involves reviewing the asset managers and the funds used to assess whether or not the strategies being employed align with the beliefs. This will include looking at the asset manager's firm-wide and fund-level ESG integration, the strategy being used, the asset manager's stewardship efforts, ESG metrics, and exclusionary criteria in some cases. Should investors find that their existing investment managers do not align with their ESG beliefs, then they could consider reviewing the market to assess if there are options available which do align more closely, and ultimately amending their investment strategy. The types of strategies available to investors has grown significantly over recent years. Equity funds offer the widest range of ESG strategies. Passive options include things like ESG tilting, so this is where the fund aims to track a modified index, where companies which score better on ESG metrics are weighted more heavily, and those that score lower are weighted more lightly. You also have exclusionary options, so this is where a fund aims to track an index which excludes certain segments of the markets that investors may deem as unethical or unsustainable. So things like tobacco, weapons, companies that violate corporate governance standards, and fossil fuels, to name a few examples. There's also now climate-aware type strategies, where the specific focus is on managing risks related to climate change. A passive fund may aim to track an index which has been constructed whereby companies who are more aligned to a transition to a low-carbon economy are weighted more heavily, and vice versa. And these often include exclusions for carbon-intensive sectors. Most active equity funds integrate ESG as part of the investment decision-making process, but some funds take this a step further, whereby they will target specific sustainability or impact objectives, and will exclude certain areas while still aiming to outperform the broader market. There's also ample opportunity to integrate ESG in other asset classes too. One example is alternative investments like private equity, infrastructure, private debt, and also natural capital. Alternative investments are positioned well to address some of the pressing challenges we face today. Direct ownership and typically longer holding periods can have a significant influence on improving E, S and G factors of an investment over its life, and can also have real-world impacts. ESG integration in fixed income markets is less prominent relative to equities, but there has been a range of new fund launches over recent years which aim to cater to various investor needs. One example is exclusionary funds, where the focus is not to provide finance to companies that aren't undertaking activities that certain investors don't agree with from an ethical or sustainable point of view. Whilst in practice it's difficult to find the perfect fund, there are options available which allows investors to take steps to align their portfolio more closely with their beliefs. The fifth step involves monitoring the portfolio over time, such as reporting on various ESG metrics at a frequency determined by the investors. Over recent years, reporting on environmental metrics has been the most popular and widely used by investors. This is because the data for metrics like carbon emissions or intensity is widely reported by companies and asset managers these days. There are other non-environmental metrics that investors can monitor, like the overall ESG or sustainability score of funds, and also governance metrics like board independence and diversity, for example. Which metrics investors report on should ultimately be determined by what they deem to be of most importance. Integration of ESG is not a static activity, And by reporting on various metrics, investors can demonstrate how the ESG characteristics of their portfolio develops over time. And finally, like I mentioned, ESG is not static, and over time, investors' beliefs may change and develop. Therefore, the final step in the framework involves investors reviewing their ESG beliefs at regular intervals. For example, this might be in conjunction with a wider investment strategy review, or where there is a significant change to the investor's circumstances. We hope you found this video useful. If you would like to learn more about how you can integrate ESG considerations into your portfolio, please feel free to get in touch.